My name is Nick Gebelt. I'm a bankruptcy attorney here in Whittier, California, and I practice throughout the Central District of California, doing bankruptcy and tax debt resolution. It turns out that one kind of a debt that's difficult to discharge in bankruptcy is a debt that's a tax. In this video, I'd like to talk specifically about income tax debt. It turns out that sometimes we can discharge an income tax debt in bankruptcy. In order for an income tax debt to be dischargeable, and this is whether it's the IRS or a state franchise tax board, say in California or in some other state, the rule is still the same. The tax debt has to satisfy three requirements. Number one, the tax return for the given tax year must have been due, with extensions if you got them, at least 3 years before the day you file your bankruptcy papers. And it is literally down to the day. So, for example, let's say you wanted to get rid of your tax debt for 2013. When's the tax return for 2013 due? It's due April 15th, 2014. Oh, wait a minute, you got an extension. Well, that means it was due October 15th, 2014. To satisfy this first requirement, then, you'd have to wait until October 16th, 2017. And if you're even 1 day early, you lose. So that's our first requirement. The tax return must have been due at least 3 years before you file the bankruptcy papers. Now notice I'm saying in that first requirement that the tax return is due, not that you actually filed it. The second requirement gets at whether or not you filed the return. And that second requirement is you must have actually filed a legitimate, non-fraudulent tax return for the given tax year at least 2 years before the day you file your bankruptcy papers. Again, there is no wiggle room, no forgiveness. It's down to the day. And then the third requirement is the tax you're trying to get rid of cannot have been assessed by the taxing authority during the 240-day window immediately prior to the day you file your bankruptcy papers. 240 days, well, since 3/8 are 24, that's 8 30-day months. Now you might wonder, well, what do you mean by assessment? When you send in your return, let's say to the IRS, it's not processed the same day because the IRS is getting 220, 230 million returns a year. So it's going to take them a little bit of time. But eventually, maybe a couple of months later, they're going to process it. If you owe them tax, then somebody there will enter into the IRS's computer system that you owe however much that tax is. That is when the tax is assessed. So we have a three-part test, sometimes referred to as the 3-year, 2-year, 240-day rule. The tax return for the tax year must have been due at least 3 years before you file the bankruptcy papers. You must have actually filed a legitimate non-fraudulent tax return at least 2 years before you file the bankruptcy papers. And the tax you're trying to discharge cannot have been assessed during the 240-day window immediately prior to the filing of the bankruptcy papers. Now that 2-year rule is a little bit tricky, so in a subsequent video I'm going to talk a little bit about where things stand there, because that 2-year rule is the subject of a lot of litigation, and there are inconsistencies throughout the United States. And in the Ninth Circuit, where we are, that is unsettled law. So it's going to be cutting edge stuff, and I'll talk to you about it in a subsequent video. If you'd like to talk further about this, please feel free to give me a call. I can be reached at 562-777-9159.